Hello, everybody. Today we are going to discuss about the marine carrier liabilities. Outline of today subject. Let's to share it with you. This is the okay. Outline. It's we are going to discuss ocean bill of lading, different types of bill of lading, methods of the cargo release and the liability for the carrier based on the Hague Visby rule, and main carrier liability exemption, and the also marine insurance, and finally for security associated with the process of the importation. There are some links, useful links. You can find it as usual, as you can see here. It's a useful information, useful YouTube link, which is explaining about the bill of lading. I know now you're familiar with the bill of lading. It's not something new for you. You have you have a good understanding. Just for safety's sake, I highly recommend you guys to watch out these links, information, just to reconfirm your knowledge. As you know, as for the ocean bill, it's bill of lading. It's a document issued by the carrier to shipper of the goods. It is negotiable and instruments, and it serves three main purposes. And just this is review because we already noticed this one. It is the receipt of the goods. It is the evidence to contract of the carriage, and it is a serve as a document of title. It means that technically it means that whoever is a holder of the bill has a title to the cargo or the rights to claim the cargo. So this is quite important to understand. So anybody who has the bill, it has a title as an ownership of the products. Again, I refer you guys to watch out this links below in the slide, and it is again helping you to have the good understanding for in the bill of lading. So let's just concentrate on the ocean BL. So we are going to have the full concentration on a bill of lading for the vessels, ocean bill of lading. So definitely, you know, naturally, whenever shipper pass the goods to the carrier, to the marine carrier, this shipping company, they must to issue a bill of lading to the shipper. So there is no restriction on the number of the bill of lading. However, when we talk about the bill of lading, three original bill of standard, it's standard normally one for the shipper, one for a consignee, and another for bank. This is the norm, but there is no restriction. You can, at the beginning, when you are contracting with the shipping company, you can define how many original bill of lading you want to receive at the after shipment. Please note, it's not possible to ask more bill of lading after you finalize everything. For example, you should ship out the cargo, and then after 2 months or after shipment, after cargo reach to destination, you want to ask for the new negotiable bill of lading. That's a very complicated process. So that's why before instructing shipping company, you should decide number of the original bill of lading and the copies you would like to receive it from the shipping carrier, marine carrier. Ocean BL. BL is considered as the title of a good for documents, much like the cargoes can be used in the negotiation because of the some of types of the BL can be endorsed and transferred to third party while the cargo is in transit. Just as I already explained to you, it's possible when the cargo it's on the ocean in a way to the destination, the buyer, the importer, based on if they have the, for example, in order bill, you are able to transfer the possession and the title of the goods to another one. So this is the one of the function. That's why we call it, this is the title of the goods. And it means the carrier hasn't been paid. So the also means that if a carrier hasn't been paid in a full transportation of the cargo, the carrier can keep the bill of lading and the goods until term and the sales are finalized. So simply, also a shipping company, if you are not paying them in full amounts, so they keep the bill of lading, not release to the buyer unless otherwise, I mean, you completely pay the money to the shipping company. Then after, they can release it to you, they can pass it to you. So even shipping company, they keep the bill of lading. It means that they are owner of the cargo. Again, look at the bill of lading. As you see here, this is the sample of bill of lading. As you already noticed, please note each shipping line, airline has their own bill of lading. More or less, you know, the format is similar, but definitely they customize based on it. They put their own logos, and also maybe layout of the bill of lading vary from one company to another one. It is the shipper's responsibility to provide accurate information, BL instruction, or also called shipping instruction to the carrier or agent to make sure the information listed on the bill is the exact and the same as the buyer's request. Normally, before issuing bill of lading, a shipping company will send you a draft and ask you to fill out and double check if everything is fine and correct. Then you submit it to shipping company and they put it on the original bill of lading. This is norm. We call it shipping instruction. Types of BL. Pay attention to this part. We are going to discuss different types of the BLs. We have the, based on a different classification, we are considering different types of BL. For example, for mode of transportation, if we are able, we can classify a bill of lading based on the modes of transportation. It could be ocean BL, we call it OBL or ocean BL. Also, we call it, we have the airway bill, which is the for the airlines. And also we have the multimodal transportation BL, which is used for the when we are combine different modes of transportation together. For example, if you're importing something from India and you want to pass it and deliver the goods in the Ottawa, you are combining water transportation together with the highway transportation. These two modes of transportation combined together, and therefore we call these multimodal transportation. We are using two modes of transportation under one bill of lading. So this is multimodal. Most of the freight forwarders, you know, freight forwarders, or this is the job for freight forwarders, they are able to handle, and they normally they issue multimodal transportation bill of lading. And if we want to classify bill of lading based on the party, we have the two party they can issue. One, we have the master bill of lading, which is issued by the shipping company, I mean original marine shipping company. They are issuing master bill. Master BL, it's in many cases is synonym to the ocean BL, you know, these two. You know, for example, if you're asking, for example, MSC company to give you a bill of lading, we call these BL master BL because it's issued by the original shipping company, transportation company. And also, meantime, it is ocean BL as well. Also, we have another category as the issued party. We call it house BL. What is a house BL? House BL, it's a sort of bill of lading issued by the freight forwarder or NVOCCs. You know, this is the normally it's a multimodal, and just imagine you're hiring a company as the freight forwarder, and they are not they don't have their own ship, or they don't have their own trucks, but they are issuing bill of lading to you, and they are responsible to carry out a cargo from the certain place to the certain destination under this bill of lading. We call these sort of BL house BL. It is the it's backed by the another master BL, ocean BL, and other term modes of the bill of ladings. But as a matter of fact, this is not the originally issued by the shipping company, you know, maritime company. They are not issuing house bill. Maritime company or the they are issuing master BL only. But freight forwarders, they are using and issuing house BL. Just check it out. For your further information, I suggest you just check out these links, which is talking about the different types of bill, especially issued from. And by issued form, if we want to check how it's possible to issue bill of lading, we have 3 methods. Later on, we review all to get all of these information again. This is just a very brief information. We have the original bill of lading, which is very normal to have it on paper. Shipping company right after ship out cargo and receive a cargo from the shipper and arrange a shipment on a vessel, and they ship it out. And then normally it takes 1-2 days after shipment, they issue a original bill of lading as per request demanded by the shipper, for example, in 2 origin or 3 original and 2-3 copies, based on a draft instruction already confirmed by the shipper. So this is the original bill of lading. So we call it order. It could be in order or straight. So we have 2 type of original BL. We can have the straight BL, original BL, or we have the in order BL. We will discover it more later. And also we have a CVA bill or express release BL, and we have a telex release BL. So you can see here, this is the talking about the for example, what is a telex release BL in this website, link available, talking about what is the original bill of lading and straight bill of lading, order bill of lading, and differences between the telex and express release. So this is these information helps you a lot to have a better understanding what is BL and so on. Also, there is a link I put here, which is again, it's a detailed explanation in this link for the what is the BL. Let's watch it together. That's not possible. So I am requesting everybody to watch it yourself. The link is available. So we'll be back here and just. Okay, as for the original bill of lading, CVA bill or express release and telex release, we have more discussion. However, you can check out about these website available, which give you better understanding and better idea. So let's back again here. As you noted here, we have the we want to just discuss about the this one, original bill of lading, which is divided into order and straight. What is the straight BL? What is the order BL? You know, just we have a definition here, as I explained to you. When you know, a cargo should deliver to the just only a specified person, which already defined, and to the only one person, and the shipping company only and only to should deliver the cargo to the specific customer. So we call it a straight BL. So it is non-negotiable. A name indicated this BL is used when the cargo are already fully paid for and shipped directly to the consignee and customer. So, and also for the shipper's order, this is our negotiable documents. It is the bill of lading are used when a cargo is purchased on a credit, for example, using letter of credit and handled through a bank. Also, shipper's order bills are negotiable, and this is the function like a title of goods. So a straight bill of lading is where a bill of lading is given or issued in original format to the name consignee. It does not involve any negotiation. So, and the cargo cannot be transferred to a consignee other than the one named in the document. Pay attention, only to the person, to the specific person. It is also considered to be evidence of the contract of the carriage as well as the receipt of goods. To the in-order bill. In-order bill is issued for the original formats and consigned to order of shipper or to order of a specific bank. So this bill is negotiable and can also be transferred to someone else based on endorsements on the bill of lading. So these are the functions, these are differences of the straight bill and also with the order bill. So this is important part. So as a different type of the bill of lading. Maybe I'm asking a question, what is the difference between straight and in order bill? This is the, could be a good question. And for the bill, it's, as you know, it's a title of the ownership, as technically that's whoever hold the bill has a right to claim the cargo. This is the definition, and consignee usually needs original bill to take action. You know, for example, whenever cargo arrived to the port of Montreal, you need to have the bill of lading to go and follow up to take your goods, your container, take it out from the CBSA. So we have the different methods of the bill. We can offer, we can just, in order to receive the goods, we can submit original bill, or also we have two other different methods. We call it telex relics or the CBA bill or express bill. It's both are possible. I will explain you. In order to have a right understanding, I'm very much asking you guys to study this one. The information exists here.
BL for picking up a cargo. Then BL is exchanged for DO, a delivery note. The importer picks up the cargo with a DO. Note that BL is not the only requirement to pick up a cargo. BL has to be exchanged to DO for picking up a cargo. The basic role of BL is explained in another video. Check the link in the explanation section of this video for more details. Now, let's look at types of BL. The main three types are as follows: original BL, surrendered BL, seaway bill. Let's take a look at it one by one. First, original BL. Original BL is issued in 3 copies. It comes in a set of 3. You may have 3 copies in 2 deliveries, to avoid loss risk as a business custom. Original BL, as the name implies, is original. An importer must have original BL, not a copy to pick up a cargo. Let's take a look at original BL flow. When a vessel leaves a port, original BL is issued and sent by an export side forwarder. The exporter sends original BL to the importer by courier, such as DHL, or and forwarder issues DO. Getting original BL, the importer exchanges it for DO. This is the flow of original BL. Next, surrendered BL. Surrendered BL is also commercially referred to as surrender. Surrendered BL is featured as speed, and copy is acceptable. First of all, what does surrender mean? Surrender means collecting BL by an original end, which means collecting BL at exporting side. Once it is surrendered, BL may not be original. The importer can get DL by getting a BL copy instead of original. Surrendered BL is stamped as surrendered, and telex release. Telex release means the same as surrender. Why is surrender BL for? Nowadays, due to high speed of a vessel, it may arrive at a port before original BL is issued and reaches an importer. Especially marine transport take only 3 or 4 days to get to near country's ports. An importer cannot quickly pick up cargo without original BL. However, unlike original BL, which sends the original document, an exporter can surrender BL by instructing a forwarder and paying the cost at export side. The exporter emails the copy of BL to an importer, and it's done. The importer can exchange the BL copy for DL. This allows for speedy trade transactions. It also reduces the risk of losing BL. Finally, Seaway Bill. Seaway Bill is a bit different from BL, and it is not a security. This will be explained at another time, but waybill is not used for any trade using LC. But waybill has a big advantage. Once waybill is issued, and the importer is identical to the consignee in the document, he can easy to pick up the cargo. In addition, there is no courier delivery cost of original BL, and surrender costs for surrendered BL. Seaway Bill is easy, fast, and cheap. The flow goes like this. An exporter initially asks for waybill to be issued, not BL. Once the vessel departs a port, waybill is issued, and a copy is sent to an exporter. The exporter emails the copy to an importer. The importer can pick up DL, being proved to be the waybill owner. In the extreme, if waybill is issued, and the importer can prove that to be its owner, the cargo can be picked up. Anyway, quick and easy is what makes Seaway Bill so special. However, there is also a risk associated with it. Because, once waybill is issued, the cargo can be picked up. The exporter may have a payment collection risk. Payment. With waybill, it is more difficult. Therefore, in order to use Seaway Bill, the business relationship with your trading partners will be important, such as parent and subsidiaries, or a long business track record. Today, I talked about types of BL. Original BL. Surrendered BL. Seaway Bill. Each of these BLs has its own characteristics. Please make sure you understand this content for your logistics job.
I highly recommend you guys to again watch this video. This is the brief and very useful information. They fully explain the animation about to have a good understanding what is the difference between original BL, telex release, and Seaway Bill. Anyhow, let's continue. Of course, it's complicated. I'm not expecting you guys to be good quickly to have a right understanding from all these information, but as you want to be a professional person in the process of logistics and the supply chain, you need to have a right understanding. You want to work for the freight forwarder, you need to have a right understanding about the bill of different types of bill of lading. Also in a business, you need to understand which sort of deal you need to have it in hand to make a job quicker. So again, be back to the original bill of lading, or OBL, which is the BL is the to order, or the order of the shipper, and original bill of lading normally is a to order, or the to the order of the shipper. It is the involved in a letter of credit, and the payments is the documentary collection through bank, maybe import requirements in a country of destination, ask for it, or the custom authorities at the destination request for the original bill of lading for the custom clearance, and simply, or maybe a buyer prefer. So these are the reasons that normally in a business, in a trade, importer asks for the original bill of lading. Many countries, they only accept original bill of lading in order to proceed for custom clearance. So as for the international trade, you need to make sure, and this is the responsibility of the importer, to define which sort of bill of lading they are looking for. So you notice in these cases mentioned here, we have to ask for the original bill of lading. If we are involved with the letter of credit, payment, import requirements, or at the destination for custom clearance, and we want to transfer to the another person, we are asking for the original bill of lading. So what is the release bill of lading means? So telex, this is the or surrounded bill of lading. It's very similar to original bill. As you notice in a video, in terms of the original bill of lading, original bill should be issued at the country of origin, and normally it's submitted and passed to the exporter, and exporter should use, for example, send it by bank or sometimes by DHL or other means of the courier services to the buyer. This process normally is lengthy. It takes some time, you know, to receive it, and sometimes from the origin to destination, it's a very short time, and you don't want to keep the cargo in the custom for the 2-3 days or 1 week to receive the original bill of lading, because you want to just quickly release the cargo, because if you keep it as much as you keep it there, you need to pay for the demurrage and detention charges, so you don't want to be charged for this sort. So you may ask for the telex release. What is a telex release? In this case, when bill of lading at the country of origin issued and submitted to the exporter again return it back to the shipping company and stamped as a surrounded bill of lading. Then shipping company will send a telex message to the destination, to its agent and to the custom at the destination, and explain that under these information these cargo can be released. This is the format of the telex release bill of lading. So telex release means a message that is sent by shipping line or their agent at a loading port to their office or agent at destination port, advising that the shipper or exporter has surrounded one or all original bills of lading that have been issued to them. So and that the cargo can be released to the consignee shown on a bill of lading without presenting of any original bill of lading. So this is the function of the telex release bill. So the telex release received its name because in the past the release would have been sent via telex instead of the email and so on. So just let's look at it when it's better to use telex release, when it's better. So telex, normally telex release usually is requested only if consignee is direct receiver, not the bank. So that's make it easy, because if the bank involved, you have a complicated process. You are not able to use a telex release. But if directly consignee, maybe the process of payment is a payment in advance, so you are not involving with the banks, any banks in between. So just after ship out, exporter can do the submit the bill of lading to the shipping company and then ask the shipping company to send the telex to the consignee. So consignee, without having original bill, can go and start the process of the receiving goods. Definitely when we want to speed up documentation delivery, when the shipper is waiting for the payment from the receiver, has usually required telex release upon buyer payment. This is also an interesting point. Just imagine exporter, I'm exporter, you are importer. We do the deal, and I already told you that 50% payment should be down payment, and you said 50% after shipment. Okay, so just already 50% you down payment, and I receive as a down payment. And then after I prepare the goods, I ship out to you. I'm not using letter of credit. I'm not using again any other cases. Just simply after shipment, I want you to, as a buyer, pay me the remaining amount, another 50%. Simply what I'm doing, I keep the original bill of lading, and I'm telling to you, upon you pay the remaining money to me, I will ask shipping company to send telex release to you. So this is the method in order to receive the full amount of money. So pay attention, that's interesting. It's useful methods for collecting money, because if I pass the original bill of lading to the buyer, I can't, collect my money. It's complicated. Unless otherwise, I mean that the importer will be very good person to pay me, and there is a trust between us. So it's over. Now let's talk about what is the C-way bill. C-way bill. What is a C-way bill of lading? It is also known as an express release. A C-way bill of lading is a document of a title used on a trust basis between the shipper and importer. Pay attention, it's a trust basis, because there is no bill of lading, there is no original bill of lading. So it's required for a goods automatically authorized for the release at the destination. So you notice for the original bill, we have the bill in paper, which should we receive it, we pass to the other side. For the telex release, again, we have the bill in paper. The point is the exporter again return it back to the shipping company, and shipping company, based on a surrounded bill, they will send the telex to the destination and they release the cargo. But in terms of the express release, there is no paper, there is nothing. I mean, just this is the trust base, and this is the ultimate, I mean, trust between the buyer and shipper. So just when the cargo goes to the destination without any special action, the consignee can be owner and release the goods. So when it's better to use the C-way bill, it's when there is a high degree of trust between the shipper and consignee. And when the shipper and consignee are part of the same group, for example, one of them, it's a mother company and just ship to the subsidiary company or the small branch in the other part of the world. So they make a job easier with the C-way bill. I mean, that's much quicker. They don't need to get involved in the complicated process, because it's not a matter of money. They are already belong to the one group, company group. And when the cargo is not supposed to be, I mean, that's traded in between, because you notice when we are using, for example, original bill, you as the buyer, you are able to endorse documents in the name of another person, and simply before cargo arrives to the destination, you can change ownership position to another company, another person. But in terms of the C-way bill, no, it's not possible. You need to wait, because only consignee is able to go and release the goods. Definitely in such a case, you should not be involved in any banking transaction, LC base and so on. Doesn't make sense, because there is no bill. When the goods are paid for with an approved line of credit, so you don't involve in the process of collecting money. So you already knows that you will receive the money in any cases, because maybe it's your partner, it's your subsidiary company. So you're not worried about collecting your money. So these are the C-way bill, and let's look at this one, different between a telex release and the express release. So let's compare these two. A major difference between telex release and express release is as follows. Just simply, with a telex release, a physical original bill of lading was issued, printed, and then surrounded. Just pay attention. We have an original bill, but when we talk about express release, there is no original bill of lading issued at all. Just this is the format, and they transmit to the destination. Both release options, both above cases, as we discussed, there is this minimize and reduce the risk of the losing original bill of lading, because as you know, original bill is quite important, and this is the means of ownership, and there is a risk of, that's losing and missing original bill. So if we are using these two methods, we are just totally remove these risks from the business. Okay, here we discuss different types of the, up to here we discuss different types of the bill of lading. Let's just before going to the next part, again back, this part is important. We'll discuss about the modes of transportation. So if we want to classify bill of lading, firstly we define based on different modes of transportation. We have an original bill of lading, we have an airway bill, and we have a combined transport bill of lading, which is, we call it multimodal transportation bill of lading. Or we can classify bill of lading based on the issued party, which is the master, which is the by carrier, or house bill, which is the issued by the freight forwarder, or NVOCC, or by issued form, which is the, can be original bill of lading, which is in a paper, and it could be in order or straight bill of lading, or it can be sealable bill of lading, which normally it is that we have the bill of lading, it's but exporter surrounded to the shipping company. Instead, shipping company will send the telex to the destination and ask for the releasing goods to the certain consignee. Or we have the CVA bill, which is the express release bill. There is no original bill at all. So this is just a format, and it's a highly trust-based between two traders. Okay, now it's a subject to discuss about the liability of the rules applicable in the water transportation. Okay, let's talk about the Marine Liability Act. Maybe it's a question, what is a Hague Visby rule? This is the just international regulation applicable to all transportation company. The same that for airlines, we have the one association to control and define the rule regulation applicable for all rail lines. We have also such a Hague Visby rules, which is the it's international rules for the carriage of the goods by sea, and all shipping company they must to follow the instruction coming from the Hague Visby rules. It's have the regular base, you know, in Hamburg, and they negotiate, they advise, and they have defined the you know, responsibility, liability of all companies, and all shipping company they should be member of these association and follow the rule. Here, I just share with you some of the information. You see here, I show you Hague Visby rule. It's complicated. I'm not expecting you guys to study, you know, just shipping company they follow, because it's very detailed rule regulation applicable. This is the liability of the carriage of the passenger by water. And we have it same for the cargo as well. So this is the CBSA, as you see. This is the justice law of the Canada. They define exactly liability of the shipping ships and the shipping company acting within the country of Canada. Of course, it's coming international, and it's related to the international. I mean, it's not just for the Canada, it's coming from the Hague Visby. So carrier liability, you know, they have a certain types of the liability, but they are limited. Normally, they want to be, they want to clarify exactly with the shippers what is the responsibility of the shipping company. They want to make it clear, everybody understands. So there is a rule regulation applicable. So make a ship seaworthy, properly manage, equip, and supply the ship, and make the whole holds refrigerating and cool chamber and all the parts of the ship and so on properly. You know, this is all related to the handling and the responsibility to do the job perfectly. And these are the base function for the liability of the shipping company. But the point is, we want to maybe understand what is an exemption and what's a main liability exempt from these activity. If, for example, fire happen, it's an act of God, war, you know, enemy, you know, public enemy, or the embargoes happening, or the quarantine restriction happen, or these are the hazardous and peril of the accident happen. You know, these are the sort of the activity, you know, events, if it's happened to the vessel, if they happen to the shipping company exempt from the liability. So they are not obliged to, pay or are responsible for the problem. It's follow here if there is a strike, riot, or inadequate packaging and marks. It's if the wastage in bulk or weight or any other loss or damage rise for the inherent defect, quality of goods, or insufficient or inadequacy of mark, latent defects not discovered by the due diligence. So these are the exemptions. It's follow again with the one important subject we are going to understand for the special drawing right. You know, neither the carrier nor shipper shall become liable for any loss or the damages to or in connection with the goods in the amount exceed 666 units of the account per package, or 2 units of the account per kilograms of gross weight of the goods lost or damaged, which is the higher. So there is a limitation, there is a definition, there is a certain payment method for any lost damages happen. So they limit, even if there is a problem happening, so liability of the shipping company limited to the SDR, or a special drawing right, which is defined by the International Monetary Fund, IMF. So there is a website to explain how much would be the payments if the amount of the goods it's not exceed for this exceeding for 6,000 something 6,000. There is they are able, they should pay for the limited SDR, but if it's the less, it's totally they don't pay anything. So this is the complicated for the for the importer exporter to recognize, because this is the something between shipping company and freight forwarders to follow. But it exists, you know, this is the liability exists. I never experience SDR case or facing the problem, as far as we have the insurance at the top of the process. So that's make it less important. So SDRs define the terms based on a basket of major currency used in international trade finance. So SDR normally defined based on the euro, US dollar, Chinese yuan, Japanese yen, and pound. You know, here it's you see the table, and this is the just definition. Why we have the SDR? Because we live in the international. That's many companies. Traveling in this global, and each they wants to use their own currency. So we are using SDR. SDR could be a reference for all companies, all nations to use as it. So SDR is equivalent to 1.38 US dollar. This website always update the latest SDR. So if any default happened by shipping company, based on it, how much they should pay for it, they define it based on SDR. So SDR is a currency. Simply, if I want to make it simple, SDR is a currency for the maritime business. So the oil shipping company, for any deal, any liability they should pay for the losing or any problem happened during transportation. They are obliged to pay based on SDR, not euro, not Japanese yen, not in the Canadian dollar, nothing, just based on SDR. And SDR, they just check it, latest information exchange rate, and based on that one, they convert to the local currency and pay for it. As you noted, we are these liability of the marine company is not enough, you know, for the international business is not enough, and it's very limited. It's very vague, and if we are shipping very valuable goods, definitely we need to have the more secure process. We need to have the insurance. That's why we have the marine shipping company. We have the marine insurance as well for any international business. We can secure the process by having the insurance at the top of the process of the transportation. So you see here, there is a possibility thief, non-delivery, pilferage, or the stowage, and the damage, water damage. It may happen during transportation. So that's why we need to have the insurance coverage to make it secure. Cargo will reach to the destination safe and sound. Carrier assume very little liability, and shippers could be liable for the more than their own shipment in an ocean disaster. So cargo owners should therefore protect themselves by taking out marine insurance. So let's to understand what is the marine insurance. So why we should have the marine insurance? This is because we want to arrange a door-to-door service and using different modes of transportation, so it's make it better. So maybe we need to use the specific term, Incoterms, it's included, you know, insurance, and we have to add the definitely insurance on the, because Incoterms ask for it. Or maybe bank asking for the insurance, because always bank as an opening bank, they want to be safe, secure for receiving goods. They asking for the insurance coverage. And also protect against general average, which is the another case, which is the very conservative shipping for the shipment by vessels. Later we will talk about it, what is general average. But one of the purpose is just protect against the general average. It is important to note that you are responsible not only for your goods, but also of the ship of or aircraft, not to mention the damage they can cause to other according to the space you occupy. So in order to have an understanding what is general average, let's to click on this link and to see, to have more information. Let me share with you this link. Okay, here you see general average. What is and how does it affect important? So just general average and what it means for importers coming here. What is general average definition? And details, completely explanation. Of course, it's too detailed, but it could be good to understand, to have it. So here we have a full explanation over the process of the what is general average. I have a video which is quickly and briefly and efficiently explain about it. Just let's to look at the video later. Okay, just back to the slide here. So guys, in order to, whenever, you know, there are different types of the cargo insurance, but for your cargo to be sufficiently covered by the cargo insurance, you need any type of A, B, C clause. So definitely, you know, just look here, we have a 3 category for the insurance. It is A, which is the most coverage. We have the B, medium coverage, and we have a C, which is the least coverage. You know, it depends on the type of products you're handling, you're exporting, depends on the value of products. It has many factors you need to consider, but which is the most reasonable for you to use. You know, mainly in a shipping, you know, I experienced majority company using C. I mean that the least coverage level. In very special case, they are using the higher level of the coverage. But anyhow, depends on the business, depends on the company policy, and depends on many factors. You know, even if you know, normally you ask, for example, you ask for the CIP, ask the exporter to add the insurance coverage on the cargo. Normally exporter consider sea level, you know, they define it, we are just going to cover sea level. So you cannot claim for the A unless otherwise from the first day you dictate them, you ask them, the insurance should be A clause, you know, otherwise normally shipping company go for a, I mean that's exporter only pay for the sea level, which is the cheapest one, which is quite natural. This is just a difference. There are some significant difference between clause A, B, and C. You know, this is the, if you want to compare, this is the just like the automotive insurance. This is the higher premium you pay, more coverage you get. You know, this is the point. As for the A, it's considered as the widest insurance coverage, and you should expect to pay the highest premium because you are asking for the total coverage. If you're asking for the clause B, it is the more restrictive coverage, and you should expect to pay moderate premium because perhaps you're only requesting the more valuable items in your cargo to be covered, or only partial cargo coverage. Or we can ask for the cargo C, clause C, if it's considered the most restrictive coverage, and you will probably pay the lowest premium, but your cargo coverage will be much less. So as I told you, the C is very common to use in international business, but it is associated with the minimum coverage. Here you see a table. This table shows you the differences in the clause A, B, and C. You see here we have a 3 column, and each column A, B, C. As you see in the case A, clause A, all the cases, all the reasons, we have a tick, green tick, so it's cover all of them. As B, it is almost 3 less. And as for the C, you see almost 6 less than the A. So this is the minimum goes to the C. But for the major subject, you see on a C, for example, for general average, all of them covered. For the both, blame, lesion, all of them they covered. For the fire, all of them covered. But this one, for the thief and the pilferage, you see here A is covering, B is not covering, and C is not covering if thief or something happened. Even for the earthquake or the volcano, you know, these cases, you see here, A, B is covering, C is not covering. So this is the difference between the 3 different clauses for the insurance. So let's also check in some exclusions of the marine insurance. In some cases, in which sort of cases insurance is not covered by the insurance. If, for example, if willful misconduct of the short, or any problem that we are sure that it was the shortage or the problem during caused by certain person, so it is not part of insurance. Ordinary leakage, ordinary loss, it's not a part of the insurance. Or insufficient packaging, if you don't have the proper packaging, it's not a part of the insurance. If, for example, if you receive the cargo and you notice there is a problem and many of items damaged, an insurance company come and observe the situation and recognize it was due to bad packing or the not using proper cases, so this is out of question, is not covering insurance. Delay is not a subject for the insurance, or you know, financial default of the carrier, or the or a deliberate damage or deliberate destruction is not subject of the insurance. If they notice the damages, it was the deliberately happened, so this is out of question. Or loss rising from the nuclear weapon, this is again out of the insurance. So these are the subjects which is not covered by insurance. If it's happened to your cargo, it is out of the insurance. So among these, one of them is more important, that's packaging. You know, this is the what you can handle it, you know, control it. For the other, no, you are not able to control, but packaging is important. You as a position of the importer, you must to emphasize exporter to use the proper packing. You know, negotiate over the packing is a big topic. I mean, you need because you know, packaging is expensive. You know, they should to use a proper, boxes or maybe woods pallets, and they need to make it, make a proper bracing inside the container so that during transportation, everything be fixed and no unnecessary movement happen during transportation, which causes damage. Definitely any movement may cause damage, especially if you're not using full container. So there might be some holes and void inside the container, which by any movement, inside pallets and boxes go from the side to side, so sliding in the container, which is very dangerous, make it unstable and also damaging goods. So package, it's something that you can control it. So let's back to the subject for what is the general average. So we want to define some words. First is general average, protection against a general average. So in a marine insurance, in case of the partial loss or emergency repair to the vessel, average may be declared. So what does it mean? Example, a ship in a storm might have to jettison certain cargo to protect the ship and the remaining cargo. So general average requires all parties concerned in the venture to contribute to the compensate the losses caused to those loose cargo have been lost or damaged, which mean you will have to post a bond or the deposit cash to gain access to your cargo. So let's watch this video together. It's help you to have a better understanding. Okay, let's go to watch a video about the general average, which can be useful and give you a good idea about what is it.
The law of general average is a legal principle of maritime law that has existed as a part of international trade since ancient times. According to the law of general average, all parties make voluntary sacrifice of part of the ship or cargo to save the whole in an emergency.
The purpose of this law,
the pecuniary expenditure or loss, in order to save property belonging to others, has the right of compensation. The risk is spread among all the owners of the cargo and the owner of the vessel. The general average act when and only when any extraordinary sacrifice sacrifice or expenditure is intentionally and reasonably Therefore, a situation can only be declared if the entire voyage is lost, for example, if the ship sinks. This would not be a general average event, since the voyage was not preserved from peril. It is up to the captain of the ship to make the official declaration of general average. Some examples of situations that can result in the declaration of general average are a fire on board the ship, mechanical engine failure, the ship running aground, a case of piracy or ransom of the ship, or getting caught in a storm that forces the ship to find an unplanned safe harbor. All of these events would require the ship's crew and outside parties to take action to save the ship, its crew, or its cargo in order to complete the scheduled voyage. As you can see, all of these example situations are unpredictable and can happen to any crew despite their level of experience on the sea. If you are shipping goods via an ocean vessel, you are party in that sea venture and are at risk of a general average claim. Once a ship captain declares general average, all parties become part of the claims process. Did you learn something new? Subscribe to our channel for more tips and insights into the international trade world.
So we understood about the general average. So in terms any loss happened during a transportation and captain declare for general average, everybody who has the cargo on a ship should contribute to cover the loss. No matter if your cargo sank or you have your cargo, you have to contribute. So this is the means of general average. So they want to be fair to everybody. We have the word jetson, and jetson, you know, its meaning means draw or drop something from the ship to the ocean. You know, when there is a storm and the captain, because they want to save the ship, maybe they threw out some of the containers to make a ship vessel lighter to be safe during a storm. So this is the jetson. So then after, captain will claim for the general average. So everybody, all the people, I mean those, you know, shippers, they must contribute to cover the loss for those which their cargo already due to the jetson threw out to the ocean. Or peril of the sea, this is the caused by the heavy water, stranding, and striking on the rock, or the collision with the other vessel. As you see here, this is the peril of the sea, and the contract for the floating object. These are the all subject. It may happen, so we want to just be safe, and this is the one can be asked for the general average. So to take off the cargo insurance policy, beside the security provided under a carrier contract of the carriage, allows a party to turn directly to the insurance company rather than the carrier. So these are the just by contracting indemnity payable by the carrier, and also the carrier may not be even be liable at all if protected by one or more these legal exemptions. So this is the sequence of the carriage. Marine insurance selection could be paid. Who pay for the marine? Pay for the insurance. Which coverage should be selected? Which is the nature of the goods to be insured? What is the type of packaging? Which is the modes of transportation? How much is the value of cargo? And which insurance clause should be chosen? These are the subjects should be considered for having the insurance on the cargo. Here we want to just check it, the process and how they estimate the cost for the total payment charges for the insurance. To insure your shipment for the replacement of the goods shipped in case of a total or a partial loss or damage, request insurance for the replacement value of the goods equal to the commercial invoice value. So always, in order to calculate the value for the insurance, they consider how much is the invoice. Check the invoice, and because invoice is telling us how much is the value of a cargo. So based on the invoice, simply they calculate like this. If the value of a commercial invoice is talking about the $10,000. So example for the selling insurance for 60% per 100. So 60% per 100 for insured value with the $12 minimum. So this is the process. 60% of the $10,000 it means that 6,000 divided on 100. So 60, it would be a total cost for insurance. This is the method of calculating how much it is the cost for insurance for the marine carrier. Of course, this 60% depends on the this CBA. If you're talking about the A, definitely it's go highest level. If we want to apply marine insurance calculation to the process based on the, for example, CIF value, which is the terms of the Incoterms, they insure your shipment for the replacement of the goods in case of the total partial lose or damages plus the cost of the shipping, the freight request insurance for the CIF or the cost insurance and freight value of the shipment. So CIF equal 10% terms. So simply we need to consider 10% at the top of the total value. So commercial invoice plus insurance plus the freight will have the, with these three, we will have the CIF value times 210%, 10% for the unforeseen costs or the charges. This is norm. And if there is a damage and the repair occur in the final destination of the goods, consignee, a facility, no freight charges are refundable. So for most destination and the commodity insurance companies sell insurance for the almost 60%, 400. So it would be as below. This is the just. Simple insurance of the goods plus freight charges is a commercial invoice is a $10,000. Insurance would be 60, and the freight charge, because freight charge is a part of CIF, will be add-on. So we will have the CIF. CIF would be this price, you know, just simply we get a sum of the 10,000, 60, and 500. It would be 10,560. Then we times to 110. As for the here, the condition tell us for the 10% for unforeseen cost. So total would be 11,616. This would be amount for the insurance. Then it would be applicable for the insurance. So this is the 60% will be applicable, applied to these 11,616. So it would be 69.70 would be a total charge for insurance in terms of CIF. You see here, CIF business, it is the total insurance charges for the CIF business. Try it. I'm not going to ask you to calculate it in exam. I don't need to calculate it. Just this is the side information for you guys to have the understand the process of calculating, because definitely when you're hiring insurance company, if you have a knowledge, so it's help you to understand how they calculating insurance charge. Just see the some of the problems and the accident happened to the vessel. It is happening in the world, so that's why we need to consider insurance. This is the stranding. As you see, is the ship stranding. It means that now it's stuck to the rock and can't move on. From here, we have another subject to talk. It is we are going to discuss about the securities. As you know, the subject of security is quite important, especially after 11 September 2009. The world faced a new changes, and the security consider how they can make it more secure, the process of the changing goods and importation. And USA was the ahead of the other nations to create a more secure process for importation. And they apply for the terms, we call it International Ship and Port Facility Security Code, ISPS code, which has the process. This is related to the maritime shipment. Just have the information. For example, if you are ship out something to the USA, maybe you should charge with the ISPS code as well, because there is some certain procedure between shipping company and the port for calling the port. They should do some process, and this is then they will charge the customers later. And we have the securities fall into three different levels in the different country. Security level 1 is normal. This is the heightened secure, and the exceptional security. This is the different level of security they consider in the different time of the year, and depends on the, for example, if the terrorism attack happened or if they are suspected to some problem, something happening. So they consider different level of the security in the ports, and definitely it impacts on the process of the import export. In Canada, we have the process of importation. We call it ACI, Advanced Commercial Information Program. Any goods wants to import coming to the country of Canada, 24 hours before departing the port of origin, they need to declare what they are bringing to the Canada. This is very important. I see, without ACI, ships cannot come to the Canada, cannot, call the port and brief to the any port. So ACI, again, it's a request transportation by water to electrically transmit marine cargo data to the CBSA 24 hours prior to the loading cargo at the foreign or the origin port. Even it is including United States, no difference, all around the world, Here I put some reference here, as you can see, CIFA, CBSA, and this is for the Federation of the Shipping Company of Canada. They have a detailed explanation about the ACI. It's very advanced and complicated, but as much as you want to be a professional person, it is good to know about the ACI. But if you're acting as an importer, exporter, you have nothing to do with ACI. ACI is only referred to the shipping company. Only shipping company, freight forwarders, they must have understanding from the ACI. But this is nothing to do with the importer, exporter. Absolutely, maritime company, they must to manage ACI because this is the responsibility of the ships. Based on packing this information, HS code you declare, they also transmit the information to the CBSA 24 hours prior to the leaving the port of origin. Because if, for example, CBSA notice special cargo is prohibited to come to the Canada, they just ask a shipping company to not bring those containers. So they don't bring it to. So this is I show you this link. Here it's one of the documents. It's a very complete and comprehensive information about the advanced commercial information and about the e-manifest, marine conveyance and arrival certification for all information related to the process of importing any goods to the country of Canada in any ports. So this is the CBSA regulation. All details coming here in this data, and about the type of, it depends on the type and time zone, and also with the type of the carrier, they must to declare information. This is the convey arrival guideline. I want to see if I can show you timetable or not conveyance arrival. Not here. Not here. How about this one? Okay, here is much easy to understand. This is the ACI information explanation exists here. Conveyance arrival certification, CACM. Also, we have it. It's coming here to explain. If you phase 2, it has the information. And with the some question answer. So these two references could be useful for you guys If you're interested to have more information, you can refer to this one. But as I told you, ACI is good to know it, but it's nothing to do with the importer-exporter. This is the subject related to the shipping company. And then after, as I explained to you already, I covered this subject, we discussed it. And we have another subject, we call it Container Security Initiative, which is its purpose is to increase security for container cargo shipped to the United States. Also, when we ship out something to the United States, we should follow this of CSI, which is just related to the state, as not for the Canada. But because if you are exporting something to a state, you need to pay attention to CSI as well. Some definition, explanation for CSI coming here. You can click on it, study more. And this is the end of the chapter. Hope you guys, please watch this video again, and also check all the links, information which already seated in the slides, especially for those information for the videos. It could be good to review it again to have more information. We cover all the subject related to process of the shipping documents, bill of lading, and how to different types of bill of lading, and also process vessel come to the port in the Canada. We already covered all these subjects. Have a good day. Bye-bye.